following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU, as well as cable TV 10 in New Bern. I hope you enjoyed last week. We had John Jertson, who's an advisor that works for me in the office, filling in as I was out of town, and I hope you enjoyed John. Might have him back here some other time. But for today, we got a lot of good information. If you have any comments or questions on the topics or the show in general, we'd love to hear from you. Our phone number is 252-633-0107. The email to the show is allthingsmoney@dlblain.com. And of course, you can visit us on the internet at our website, www.dlblain.com. There you'll find information about myself, my firm, as well as the archived copies of the show. Well, I wanted to address one thing to start the show today. I guess last week, for the first time in quite a while, investors got a little bit rattled with the markets after reaching multi-year highs. There were a couple of down days, and of course anyone investing in Japan is well aware of what happened last week. On Thursday alone, the Nikkei stock average, which is the Japanese equivalent of the S&P 500, it's just an index of Japanese stocks, dropped 7.3% in one day. So that's a lot. That's a big drop for people that thought stocks were a no-risk type investment. If you remember back a couple weeks ago, we did a show on why bear markets are necessary to make returns. Well, people in Japan on Thursday were reminded of that, which, by the way, on the same day, the S&P 500 was down as much as maybe 1.5%, but finished only slightly down a little bit for the day, which goes to show you there is still some benefit to international diversification. Now, some would suggest that it's really only working if you're a foreign investor diversifying into the U.S., that Europe has been having its problem. But Japan has had an amazing run the past year or so, just practically printing money in the stock market. And so this correction of 7.3%, certainly if you bought in on Wednesday, was sort of an ugly day, but overall it's been a very good year for the Japanese stock market. Now, what caused this and why do people do this? How could stocks be valued at one thing one day and then the next day people feel like they're valued 7.3% less? Well, a lot of it had to do with fears that interest rates would start rising, that as interest rates rise, people are fearful that the value of stocks would fall significantly. And so something spooked them. There was some Federal Reserve minutes going on, and of course Japan has their equivalent of the Federal Reserve, and so it kind of spooked them. Now, one of the things that this brings up is if you are an investor, a U.S. investor, a lot of people have been gravitating towards high yield investments in the stock market, utilities, consumer staples, things like that, stocks that don't go up as much as the market but don't go down as much either. So as we look in here in the United States, the U.S. stock market is up about 12.7% in the first 4 months, and it added another 3.5% or so in May. This data is as of last week when I was doing the research for the show. Stocks with high dividends had an even higher 16.4% return through April. So the first half of the year, the low volatility, high dividend stocks were certainly doing very well. In May, they fell behind. They added a little bit less than 3%. And low volatility stocks, kind of the same story. They were up significantly the first part of the year and flat. REITs lost about 1.2% so far in the month, and utilities fell 5.6% in May after being up 19.9% the first 4 months. kind of off the track of this story, but it just goes to show you that trying to pick which sector is going to outperform the market, sure, maybe you were right the first 4 months, and maybe you were able to get out of those and switch around, but we feel like that's kind of a losing proposition. And in fact, in 1 or 2 days, that advantage can be wiped out in 1 or 2 trading days. So it's generally not a good idea to try to shift in and out short term in these sectors. These conservative areas of the market have done extremely well, but they've gotten very, very expensive. For example, at the end of April, utilities were trading at almost 23 times the earnings over the past year. Now, sometimes we see numbers like that when people are projecting into the future, but that's a trailing PE. Low volatility stocks were about 25 times. The S&P 500 was about 21 times earnings. So we see that these stocks had gotten expensive. Now, one other thing we want to look at is, well, what happens when interest rates rise? We haven't had a period where we've gone from such low interest rates today up. We have had periods of rising interest rates, of course, back in history. One of the most recent times was 1994. The Fed raised rates in what would turn out to be 5 increases that year alone. In 1994, if you remember, maybe you don't, but they raised it 5 years that year. The Fed had been creating money like crazy, flowing into securities. And on the day that the Fed raised the interest rates, the Dow dropped 2.4% because people were uncertain as to how far the Fed was going to go, what the Fed was going to do. Now, for the year, the markets kind of went up and down through 5 interest rate increases. Overall, for the year, the market earned 1.3% for the full year of 1994. Once again, rising interest rates, Fed rose rates 5 times that year, yet the market finished up. For the year, utility stocks lost 15.3%, muni bonds 5.2%, emerging markets, intermediate term treasuries, gold. So there was no safe place to hide. I mean, everything had a difficult time with rising interest rates, and some of these low volatility, high paying, interest sensitive stocks, which are supposedly the conservative, your utilities, consumer staples, REITs, things like that, got the hardest hit of all. So we see that these type of investments, they definitely have a place in the portfolio, but people have been overloading them recently, and we just want to caution you that when interest rates do rise, these interest-sensitive sectors of the economy are going to get hurt the hardest. So make sure that you're not trying to time the market or time the sectors, and maintain a well-diversified portfolio of different types of investments, and don't just chase these high-yielding stock and parts of the market. Okay, well, that brings us to the end of our first segment, and we'll be right back after a short break. We'll start talking about some debt issues.